Welcome to The Explainer. Today, we're going to talk about something you've probably heard about, especially from the movies, short selling. It's this wild idea where you can actually make a fortune by betting on something to fail.
So let's just start with what is, frankly, the weirdest thing about short selling. It's this central paradox. How can you have a trading strategy where your upside, the most you can possibly make, is totally limited, but your downside, what you could lose, is, well, infinite? It sounds completely backwards, right? And you know what? In a lot of ways, it kinda is.
You've probably seen this in action, right? Think about the movie The Big Short. You had these investors who saw the 2008 housing crisis coming, and they made this massive bet against the market. They were betting it would all collapse. And that's really the heart of short selling. You're not betting on a stock to go up. You're betting it's going to go down.
Okay, so let's get into the nitty-gritty. How in the world do you actually make money when a stock's price is falling? The way it works is pretty counterintuitive. All right, we've all had the classic investing mantra drilled into our heads. Buy low, sell high. Simple enough. Well, short selling takes that idea and just flips it completely on its head. With shorting, you sell first, and then you hope to buy it all back later at a much lower price. And that gap between the two prices, that's your profit.
But wait a second. This brings up a pretty big and obvious question, doesn't it? How can you sell something that you don't even own in the first place? And this right here is where it gets really interesting.
Okay, let's walk through an example to make this super clear. Imagine a company, we'll call it Plain Bagel Co., and its stock is trading at $10 a share. We've got two investors. Investor A does the normal thing, right? They go long. They buy 1,000 shares for $10,000. Simple. But investor B, they decide to go short. They sell 1,000 shares of a stock they don't even have, and suddenly they have $10,000 in proceeds. So here's how that magic trick actually works. Step 1, you borrow the stock. Investor B goes to their broker and says, "Hey, can I borrow 1,000 shares of Plain Bagel Co.?" The broker says yes. Step 2, they immediately sell those borrowed shares on the market. Boom, $10,000 cash. Now, the whole game plan hinges on step 3. You wait. You hope that stock price drops, and then you buy back those 1,000 shares for way less money. That's called covering your short. And finally, step 4, you return the 1,000 shares you borrowed back to your broker. And whatever cash is left over from that original 10,000, that's yours to keep.
Okay, but hold on. There's a huge what if here. In that second step, investor B got $10,000. But what if they're wrong? What if the stock price doesn't go down? What if it goes up, say, to $15 a share? Now they need $15,000 to buy the shares back, but they only have 10. So where does that extra $5,000 come from? This is where a little something called margin enters the picture.
Right, so you can't just do this with an empty bank account. The broker isn't crazy. To be able to short $10,000 worth of stock, our investor B has to put up some of their own cash as collateral. In this case, $5,000. Think of it like a security deposit. It's a safety net for the broker, making sure there's money there to buy back the shares, even if the trade goes south.
Now, this whole margin thing, it creates a really powerful effect called leverage. And leverage is a game changer because it basically amplifies your results. Let's look at the best case scenario for our short seller. Let's say investor B was totally right, and Plain Bagels Co. stock just tanks. It drops by 50%. And here's where you see that power in action. The stock plummets from $10 down to $5. Now investor A, who bought the stock, they're having a bad day. They've lost half their money, a negative 50% return. But investor B, they're celebrating. They take $5,000 from their pile of cash to buy back the shares, and they get to pocket the other $5,000 as pure profit. Now think about it. They only put up $5,000 of their own money to make this trade happen. So a $5,000 profit on a $5,000 investment, that is a 100% return. Wow. But, and this is a huge but, leverage is a double-edged sword. It's not just your friend. If it can amplify your gains like that, you better believe it can do the exact same thing to your losses. If the stock had gone the other way, if it had gone up by 50%, investor A would be sitting on a nice 50% gain. Investor B, on the other hand, would have lost their entire $5,000 margin, 100% loss. Ouch. And it doesn't stop with just the risk. Shorting has these hidden costs you have to worry about. For instance, because you borrowed the shares, if the company pays out a dividend, guess who has to pay it? You do. And just like taking out any other loan, you're paying interest on those borrowed shares for as long as you have the position open. Sometimes that interest is pretty low, but for certain stocks that everyone wants to short, they're called hard to borrow, that interest rate can go through the roof.
sometimes over 20%.
So you've got this amplified risk, you've got these extra costs, but that's still not the whole story. There are some other dangers that are totally unique to short selling, things a regular investor just never even has to think about.
Okay, let's talk about two of the big ones. First, there's something called buy-in risk. This is basically your broker calling you up and saying, hey, I need those shares back right now. They can do it for any reason, at any time. So even if you're convinced the stock is about to crash, you can be forced to close your position and take a loss. Then you have the short squeeze. This is the stuff of Wall Street nightmares. A stock starts ticking up and all the short sellers get nervous, and they all try to buy back the shares at the same time to cut their losses. But what happens when a ton of people try to buy something at once? The price goes up. And that just makes the problem worse, forcing more short sellers to buy, which pushes the price even higher. It's a vicious, painful cycle.
So when you add it all up, the leverage, the hidden costs, these crazy risks like a short squeeze, it all brings us right back to where we started. It brings us back to that really bizarre, skewed payoff that makes short selling so different.
Just look at this comparison. It tells the whole story. On one side, you've got investor A, our regular, long investor. The most they can lose is what they put in, right? 100%. The stock goes to zero, the money's gone. But their potential gain? It's unlimited. A stock can go up forever. Now look at investor B, the short seller. Their world is completely upside down. The most they can gain is capped. If the stock goes to zero, great, they get their profit. But that's the absolute limit. But their maximum loss, it's infinite.
And why is that? It's simple, really. A stock's price has a floor. It can only fall to zero. It can't go negative. So the best-case scenario for a short seller is that the stock becomes worthless. But there's no ceiling. A stock can go from $10 to $20 to $100 to $1,000 and beyond. And if you've shorted it, you are on the hook to buy it back, no matter how high that price goes. Now look, short selling definitely has its place. It can help keep markets honest, but it all boils down to one critical question you have to ask yourself. You are literally betting against a company that is doing everything in its power every single day to prove you wrong. You're fighting the natural upward drift of the market. So the question is that limited upside, that capped potential for profit, really worth taking on a literally infinite risk?